Now it's time to bring in our first guest, author Peter Schiff. He's the chief economist and global strategist at Euro Pacific Capital. Peter, thanks for being back on the show today.
Oh, my pleasure.
Now, this isn't going to be a fun interview because to me, the fun interviews are the guys that were on my show a year ago. Their predictions turned out to be totally incorrect, and I get to put pressure on them and have some fun with it. In this case, we asked you back on because your predictions from nearly a year ago are actually coming true. So let's start with the first one. You said that you think at some point we're going to see a market drop of 50% or more at some point in the future. Now, that's not coming true yet, but I happen to agree with that. But the market now is finally showing some signs of weakness. So do you still see a market drop of that significance on the horizon?
Well, without the support of the Fed, that's definitely going to happen. But, if the Fed creates enough money out of thin air, the Fed can, prevent nominally the prices of stocks from coming down. But in real terms, there's nothing the Fed could do. But, the predictions that I made that really have been coming true recently were my predictions that the Fed would not be able to normalize interest rates, that it would abort the process prematurely. That's already happened. The Fed never got much above 2%, and now they're back below 1, headed to 0. I also said the Fed would never be able to shrink their balance sheet, that they would have to abort that process prematurely. That too has happened. In fact, the Fed has already gone from quantitative tightening back to quantitative easing. They're not calling it quantitative easing, but that's exactly what they're doing. And I think this new round of quantitative easing is going to be larger than the first 3 rounds combined and even more destructive to the economy.
Well, you beat me to the punch. I was about to get to those things. You're absolutely correct. One of the things you said is you thought they'd continue trying to tighten, and then they'd have to knee-jerk reaction, whipsaw back in the other direction, start lowering interest rates as soon as we hit a recession. The reality of it is they're already lowering rates, and we haven't hit a recession yet. So it's actually happening prematurely in some ways, and it all started in December. It all started, I believe, a month after you and I last spoke, when the Fed was trying to raise rates one last time, and the bond market basically said enough is enough. And the bond market didn't let long-term yields rise ahead of short-term yields, and they really didn't give the Fed enough room to raise.
Well, the only reason the bond market started to rally and long-term interest rates declined was because bond investors were seeing what the Fed was denying, that the economy was headed into recession. And what the bond investors are betting is that the Fed will make the same mistake in the next recession as it made in the prior 2, which is to reduce interest rates and relaunch quantitative easing. So the bond market is just trying to front run what they know the Fed is going to do, while the Fed is in denial that the economy is headed for recession. But the worst thing that the Fed could do is cut interest rates and do more QE, because what is really the main problem underlying the U.S. economy is that interest rates are artificially low. They're too low. Interest rates need to be much higher. They should have been much higher a long time ago. But by artificially suppressing interest rates, the Fed has prevented the economy from restructuring along the lines that would lead to a real economic growth. I mean, that's why Donald Trump was elected president, because 8 years of Obama did not deliver real economic growth because of the Fed's artificial suppression of rates. All we did is inflate a big, fat, ugly bubble, which was what candidate Trump called it. And so the voters understood that things were not as good as the media and Wall Street and the Democrats were claiming. And so they voted for Trump. But of course, now Donald Trump is claiming that that big, fat, ugly bubble is legitimate economic growth, when it's not. We have the same phony economy under Trump that we had under Obama.
It's the same bubble you and I talked about a year ago. So we need to leave it there, take a quick break. We'll be back in a minute. Stay with us. We'll be back in a moment here on The Income Generation. I'm David Scranton, and we'll be back with Peter Schiff. Now it's time to bring back in author Peter Schiff, chief economist and global strategist at Euro Pacific Capital. Thanks for sticking around.
Sure.
Of course, if interest rates are allowed to float back upward again, then essentially that'll make the next recession that much worse, will it not?
Well, the next recession is going to be horrible. I mean, that's already baked into the cake based on what the Fed has done in the past. We need higher interest rates. But of course, when interest rates go up, you're going to see bond prices crash, stock prices crash, real estate prices crash, banks fail, bankruptcies, foreclosures, investors are going to lose a lot of money. A lot of bad things are going to happen when interest rates rise. Unfortunately, those bad things have to happen. Otherwise, even worse things are going to happen if we don't let those things happen. And that's why the central bankers and the government has been kicking the can down the road, because they don't want to deal with that reality. They don't care if they make the problems worse, so as long as they blow up on somebody else's watch. That's been the name of the game. But if you really care about the U.S. economy, and it's unfortunate that President Trump doesn't, he just wants to get reelected. He doesn't care about actually helping the U.S. economy. But if he did, we would actually swallow the bitter tasting medicine that is necessary to really cure what ails us and put this country on a path back to greatness.
Well, I'm an advocate of hands off when it comes to Federal Reserve in large part. And I think they've gotten to the point now where they've kind of taken the role of God, where they feel like, gee, we can micro manipulate every little thing. And, it's like the human body. If you try to micro manipulate every little thing with drugs, there's a yin for every yang. There's an equal and opposite reaction. And I agree with you. I think eventually the day of reckoning could very well be dire. And speaking of that, without getting too technical today for our viewers, you'll know what I'm talking about. But all this stuff we've seen over the last few weeks with the Fed funds rates having jumped up overnight and the government stepping in really at the beginning of October for 2 weeks with $75 billion a day of repurchase agreements. And it seems like when you go out and you look at people to find out what's causing all this, nobody really has a solid answer. But somebody knows. Somebody in the big banks knows. Somebody in the Federal Reserve knows what's causing this, and nobody's talking. Any thoughts on that?
Basically, that's the free market raising interest rates. Interest rates, as I said, are much too low. We hardly have any savings in this country, and we have tremendous debt from the government on down. Everybody is borrowing. Nobody's saving. Interest rates should be substantially higher than they are, and they would be but for the presence of the Federal Reserve, which is artificially manipulating rates and influencing the market, and the result of which is a misallocation of resources, malinvestment, this big divide that you have between the very rich and everybody else, because very rich are benefiting from these monetary policies as owners of assets at the expense of everybody else who has savings or works for wages. Their standard of living is going down precisely because of what the Fed is doing to delay the day of reckoning. But what's happening in these credit markets is rates are starting to rise, and the Fed is panicking to try to suppress them to hold off the day of reckoning. And so they've basically relaunched quantitative easing. They're just reluctant to call it what it is because now there's a negative connotation with QE, because we had to do that when we had a financial crisis during the Great Recession. So why are we doing it now? If the economy is so great, why are we going back to the emergency measures that we used following the worst financial crisis since the Great Depression? And, the irony of it is, the reason they called it quantitative easing, because they didn't want to be honest originally, because what quantitative easing really is monetizing the debt. It's inflation. And so the Federal Reserve is desperately monetizing debt and creating inflation to delay the day of reckoning. But it's not going to work, because we're going to have to deal with these problems sooner now rather than later.
It's funny, Peter, everybody thinks that the Fed sets the federal funds rate, and as we're finding out now, they really don't set it. It's still supply and demand of money. And you're right, we didn't have an economic recovery. We have no inflation in our economy. What we've had is asset inflation from all the QE. So, Peter, we need to leave it there for today. Thanks so much for being back on the show, though. I can't wait to talk to you again in a few months to see how true these other predictions pan out in the future. Thank you. You stay with us. We'll be back here in a minute on The Income Generation.